People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and I'm here each week with Charisse as we talk through some of the issues of retirement. Hopefully, we can answer some of your questions. And if you have concerns and you don't have that person in your life yet who's going to help you kind of navigate through retirement and what this is all about, that's why we have this show to introduce you to Charisse. How are you doing today? It's summertime.
It's great. I got a great tan, Randy.
Yes, you do. Yeah, every summer you do. You're one of those people that gets deep tan. Others of us burn. You tan. Okay.
I know. It's super tan city during the summer for me. I actually have to wear long sleeve shirts and stuff because I get too tan. Right?
Okay.
And the ladies, as you're listening, as we get older, we got to protect our faces. So
there you go.
I try to be very cautious there. But it's Father's Day weekend.
Yes, it is.
I know.
Yes. If Dad is still around, make sure you're spending some time there. If not, nice thoughts about Dad. And as a matter of fact, your dad actually, named Zinnia Wealth because he was in the landscaping business and all about the flowers. And that's kind of where this all came from, didn't it?
I know. My dad was amazing. He's passed away. He had cancer in 2019, unfortunately. And I just remember when I started the business, I talked to him about stuff. He was such a visionary and he was so creative. And I just even remember when I was in college, if I had to write a thesis, I would get stuck. I'd be like, Dad, I'm stuck. I just need 2 sentences. Get me out of this loop. And he'd give me those 2 sentences. I'm like, all right, bye, Dad. And it was funny. Fast forward, starting the business. And then, 10 years into the business, I wanted to change the name to Zinnia Wealth Management. Well, I didn't know what it was. I just wanted to change the name. Mm-hmm. And I worked with a couple of marketing companies for a year and I could not settle on what I wanted to do with the name. So one morning I just called him. I was having my coffee, looking out the window on a Saturday, and he lived in the Keys and I know exactly where he was sitting. I was like, all right, Dad, I'm stuck once again as an adult and I need help. And you know what he said? He's like, you're naming your company all the wrong things. He's like, why don't you do me a favor? Because he owned a landscape nursery in the Keys. Why don't you Google flowers? I'm like, flowers? All right. I Googled flowers and Zinnia popped up. I went, oh my gosh, that's a pretty neat name. That's female-ish. It's kind of masculine. And he told me the whole story about zinnias and how they really groom and do weed themselves. And Charisse, I know you're a green thumb. So, he wouldn't say Charisse. He always said Reese, by the way. I have a nickname named Reese. I don't know if you guys know that. He'd say Reese or Reese. And he would just say, you should plant some of those in your yard. And you would actually have a really pretty yard. Because I was terrible.
But you also explained to me that zinnias come in all different shapes and fashions and colors and things like that. And that kind of goes along with the idea that we're going to build a portfolio for you that's unique and it's different and it's different from everybody else. So it really does fit.
It really does. And he's like, it was a cool start and we just took off from there. So he was always so amazing, but so many great memories. He is also the reason why I donate and give so much to so many charities. He had a heart when we were at our poorest, right? Fishing under the bridge for food. And he would say, we're going to raise money for the cat lady, or we're going to raise money for these kids who need a Christmas tree. And I'm like, we need a Christmas tree. Mm-hmm. Mm-hmm. But I just learned it wasn't about us. It was always about other people. And so that's kind of how I live my life.
Well, we do that every day here on the show, and this is what Charisse's mission is to help you in your retirement years, not just, getting ready for retirement, but walking through it with you. And we've got some stories about that today, and we also have a fun Father's Day story for you coming up a little bit later on. But Charisse, we're going to start today with one of the big questions we always talk about. When you go in to sit down with a financial advisor, you should know when you walk out what your paycheck is going to be in retirement and where it's coming from. And Investopedia's got an interesting list here. These are the places where people get their income from. How do you get paid in retirement? It comes from these places. 30% on average come from Social Security. We probably know that. This was surprising to me. 27% comes from earnings. So people doing part-time work. So they're still working in retirement a little bit here. 23% come from either savings or pensions, which are disappearing. This is what I want to dive into here. 12% of income for retirees comes from their assets making money. So your money making money. Now, when I look at that in the shape of a pie, only 12% here is your money making money. Charisse, that seems like a really low number from me. What do you say to that? When you put together a portfolio, is there more set aside to make money for you?
Yes. I don't even understand this number.
More than 12, huh? Okay.
Yeah. I mean, let's put some math together. If you have $1 million, that's more than 12%. Right?
Well, if you had $1 million, that means $120,000 of that money is making you money. Okay.
I know. Okay. I'm gonna make sure I got this right. Yeah, that's insanity. And so most people who come into our office, they have, $500 to, $4 million, $5 million. And to say, hey, we're only going to invest, 12%, they would walk right out the front door. So most people invest all of their money minus maybe 10%. I mean, the hard, fast rule is keep 5 to 10% of your total dollars that are investable assets liquid, like cash equivalents, CDs, money markets, or savings accounts, and the rest gets invested. So if you are only investing 12% of your money, which is an insane number to me, that means you're ultra conservative, and you're going to lose to the inflation game. And depending on what you spend, you're risking running out of money. That's a big one. So what I'm curious about is most of our clients pull a heavy amount from their assets. So if we only invested 12% of their assets and we're pulling out 4%, we're going backwards.
Yeah.
Because we need all that money invested. It doesn't all have to be risky, right? But if we're looking for an income source, if you get Social Security, let's say you need $80,000 in income in retirement. And between you and your wife or you and your husband, you are pulling in $40,000 in Social Security.
Okay.
But we have a gap. We need another $40,000, right? And so let's say you save, let's say a simple number, $1 million. Well, 4% of $1 million is $40,000. But if you only had 12% of that invested, you'd run out of money in short order. So you want to make sure your money is invested. If you're a risk taker, that's okay. We just need to know where you're pulling your money from and that really dialed in withdrawal strategy. And if you're super conservative, it's the same thing. You don't have to have all your money in CDs. You don't have to have all your money in annuities. You don't have to have all your money under the mattress. Let's do some mattress money if you want that. Let's do some CDs. Let's do some money markets. Let's do some fixed income funds that are actually working well right now, because those have a very low standard deviation, which is that wobble jiggle effect, right? If you're ultra conservative, and split it up. So a conservative person, Randy, can actually be very diversified in their income plan in the safe money strategies if they didn't want the risky side of it. So it's really just doing the math, coming up with a plan, and understanding what your options are. But unfortunately, when you go to a big bank or brokerage firm, your option is 60-40 cash CD, and that's it. And that's not a plan, and unfortunately. And so we get very creative here at Zinnia Wealth.
Well, I think that what I really got out of that is that you can invest a lot of your money, but it doesn't have to be invested at risk or in heavy risk. There are different levels of risk in investing. And these are the things you can sit down and talk to Charisse about. You may be very conservative and say, I don't like that stock market. That's okay. There are other places to put your money with less risk than that up and down of the stock market. Let's talk through that. Give Charisse a call and get a date on a calendar. If you go to the website, you're going to see a gold box there. Go to zinniawealth.com. Gold box says complimentary retirement consultation. What's that? That's just us getting together and talking through all of this and just saying what's got you concerned, what's got you bugged, what's got you worried, what do you want to do in retirement? Let's have that conversation. 833-368-3680. Again, 833-368-3680 or zinniawealth.com. Okay, in the early 80s, there was a study done where they asked people, rate your driving skills. Are you a good driver? 93% of people said that they were above average drivers. That is mathematically impossible. It just can't happen. Right. 93% of you cannot be above average, okay? All right. Now, not long after that, there was a study done asking people on how they rated their skills in planning for retirement. 67% of people said, yep, I'm good on my own. Sometimes perception is not reality, okay? Yeah. Sometimes we overestimate how well we can do at something. So I want to address the people who are listening today who are doing this all themselves. You're do-it-yourselfers. That's fine. A lot of information out there, and some of you can do it. But Charisse, if you sit down with somebody who's going, I've been doing this myself. I just want to kind of check the checker here. Can you run this? What is it that you see that sometimes the DIYers forget or they get wrong or their eyes get big and go, never thought of that one, Charisse. Okay, talk to me more. What is it?
Number one, it is taxes. DIYers totally forget the tax plan. And they also don't pay attention on the withdrawal strategy because a lot of the DIYers, they have a Vanguard fund and then they have a cash fund. And that is it. Okay. So when the markets crash and burn, there's no plan. And when they need cash, there's never enough cash because they're waiting on the sidelines to invest it and they might have invested it. And I always see a problem there. And that's when they start to come to us when they realize, hey, I missed the boat here. Or, hey, I needed income and I had to take withdrawals when the market went down. But the taxes are key, like clockwork. Because a lot of the DIYers that come in here, they're very smart, right? They're astute. Yeah. They've been following the market forever. They start to come in because they just want to double check. Like, do I have it all together? And when they turn about 70, they come in at 75. They're like, just manage my money, Charisse. It's like how it always works. I'm done. But when it comes to the tax plan, they're like, Charisse, we know nothing about the tax plan. I had somebody who came in, a couple weeks ago, and they had $2 million in IRAs. And they could have been rolling over dollars like the last 6 years, but they never did because they just weren't paying attention. They didn't know what the value was. And they did go in and see another advisor asking about the tax plan and how they can help them. They were a deer in the headlights. Like, we don't do taxes. You got to go to the CPA. And then they went to their CPA and the CPA's like, I just do the bookkeeping. I don't do your tax plan. So it's a vicious cycle in the financial services industry because most advisors don't focus on not only just the bookkeeping and working with our CPAs, but also the tax plan and showing them in real dialed in software. Hey, if you roll $10,000 a year for the next 10 years, $20,000, $100,000, I have clients rolling $200,000 a year for so many years. What does it bring to your household in 10, 20, and 30 years? How much you pay in taxes? How much you save in taxes? How much more do your heirs that inherit this money pay in taxes, or do they pay no taxes? So people just want to see that, and most advisors just can't give that answer. And so those DIYers love coming in because that's when they start working with us. They're like, oh, this is good because we're putting hundreds of thousands, sometimes millions of dollars back in their pockets with the tax plan. And they're always so shocked because math does not lie. So it's really important to understand that.
Well, I found a story this week. We'll probably dive into it a little bit more next week, but here's the stat. 70% of retirement plans that fail, that failure can be traced to a misstep in the first 5 years of retirement. So you get into retirement and you're going along and things are going fine. And then about 3, 4, 5 years in, you go, wow, I'm spending a lot more money than I thought. or I didn't think that this was going to happen, or what is an RMD? And this is where I think it's so important to sit down with Charisse. I know that this show is designed for people getting ready for retirement to sit down and build a plan. But if you're in retirement and you're in those first 5 years and you're just kind of tiptoeing in and you're trying to figure out as you go, and then all of a sudden you start to see that balance go down and you start to panic a little bit, come on in. Come to see Charisse and let's see what's going on. Okay, let's get you that income plan that you need that's going to make you feel confident that the money's going to be there for you, not for the next 5 years, but for the next 20, 25 years. Give Charisse a call. Here's the number, 833-368-3680. Let's do that second set of eyes for you. 833-368-3680. It's a no-cost, no-obligation look at your retirement, or use the website, zinniawealth.com. Click on the gold box, and you'll be on your way. All right, so if you're thinking about a Roth conversion, most of your money's in a 401k, and you hear this, I need to move money from the tax place to the non-tax place. Okay, the question is, how much? How much should you do? What is the strategy here? Well, MSN had an article that said if you convert, here's the magic number, $43,000 or less per year, it'll keep you in the 12% tax bracket. And I asked Charisse about that, and I said, did you look at the article? And we both said they pulled the article down. So what does that say about this? Okay, first of all, let's talk about the merits of this. $43,000, is that the magic number? How can anybody say that's the magic number, Charisse?
That is insane to me. I mean, that no wonder why they pulled it down. And somebody listened to that article, Randy, and they probably followed it, and they're never going to look at the article again. And they called their advisor, and advisor's going to do it because the advisor doesn't have a clue. He's like, okay, if that's what you want to do, is what you want to do. But if you have $250,000 or $500,000 or $1 million or $2 million, where in the world does that number come from? And it is also, you got to look at what your income is. Are you on Medicare? Did you just sell a house that year? This is such bad information that robo-advisors and the talking heads throw out there. Big company.
Yeah.
And man, what a lawsuit. I'm disappointed actually, because there's math you have to do.
This is too broad brushstroke. This just reminds me of, national people talking on the radio in very vague, generic terms. That's exactly what this is. But, when you start giving out tax information or tax advice, and it's very generic like that, that's why probably they pulled that thing down. We got to watch out for this stuff, Charisse.
Yeah, because it really does matter to get it right. You don't want to pay more taxes than you're expecting. You need to know, what is the value of rolling this IRA over to a Roth over the next 5 or 10 years? Is it for you? Is it for your surviving spouse? Are you actually doing it for your beneficiaries, right? And if your money's going to a charity, then you don't need to do it most likely, right? So you have to put math into the plan. You got to test it, not just once, twice, 3 times, and make sure. And every year you retest it. This is why you work with a fiduciary advisory firm that actually does tax planning, that understands this. Because once in a blue moon, somebody walks in, Randy, and I'm like, you know what, for you, I literally just happened. They had $200,000 left in their IRA. They're like, hey, what do you think about us roll? Then they had a $3 million portfolio. They've already been rolling stuff. They're like, what do you think? Should we roll this last $200,000 over? And I did the math. I'm like, actually, no, based on your income and where your tax bracket is, it actually doesn't really matter anymore. And they're like, oh, that's good to know, because they were going to roll over to another $200,000 this year. And because we did the math, I'm like, if taxes go up this high, it still doesn't make a difference based on their tax brackets, which was interesting to find out. And and I love doing it. For some reason, the whole tax conversation, I get excited about it. I'm such a dork sometimes, but I get excited. Yeah, we got SpaceX, right? Yeah, I'm excited, but I get more excited over tax planning.
It is true.
You would never know that about me, and so I do enjoy it. So if you want me to geek out on stuff you don't even like or understand, you just come in and we'll hang out, and you'll just be like, I want to hang out with a geek financial advisor that likes this more than me.
Well, there's so many different benefits to this that I don't know that a lot of people see. And what I like to describe it is there's benefits for you, and then there's benefits for your heirs. And one of the things about this is if you look at your 401k, your IRAs, that tax deferred money, and you say, okay, I'm going to need probably $30,000 or $40,000 a year out of that account. So you go along and you're going along, and then you hit 73 and then you hit this RMD thing, and then all of a sudden the government looks at you and say, oh, no, you don't take $30,000, you take $80,000 this year. And now you got a tax problem. And Charisse, I don't know. We talked about DIYers. This is the kind of thing that catches people off guard, doesn't it?
It does. This is why you don't DIY alone on especially this strategy. And of course, if you're a CPA or an accountant and you understand it, that's a different story. You could really hurt yourself. And I do say it's a domino effect. And those domino effects, they could be crippling. They could really change the outcome if you get it wrong up front. Right. And it might not do what you want it to do if you don't understand what the outcome is, but you're just assuming you understand because you did some math. You listen to Clark Howard over on the radio here. You go and open up the MSN magazine online and you're like, oh, that's it. 43. Okay. So we have to be careful when we make our moves and we need to check it twice. And this is why we stress test retirement plans here. The stress test could be on the investment side. It could be on the income side, but we're also stress testing your legacy plan, your long-term care plan, your Medicare plan. I mean, seriously, if you're not stress testing your Medicare plan, boy, you're screwing up because if you make the wrong move when you leave your employer, it can be pretty crippling. Like if you're supposed to decide, hey, do I take my employer plan or should I come over to this Medicare side and get a supplement? But the employer plan's better, or maybe the supplement's better, just depending on premium and what they offer. I mean, we have to stress test all of these things because it's not a one size fits all and it is confusing. And we're here to take the confusion out of retirement planning for sure.
Well, the dominoes, as we talk about, continue to click and fall as you go through this. And like in my example there where I said, you're taking out $30,000, $40,000 out of your IRA and you're going along just fine. And your Medicare premium is $205 a month. And you're thinking, I've got this. I'm not getting taxed on my Social Security. And then you hit RMDs, and then they'd say, oh, no, you got to take $80,000, and that makes your Medicare premium higher. That triggers Social Security taxing. And I mean, that's just the stuff that happens to you. Now, if you start to look at down the line, when this money starts to go to your kids, would you rather give them a tax-infested account, or would you rather give them something that they can use completely?
And think about it. If you have, say you have $1 million in IRAs, your kids that inherit this money are likely going to be taxed somewhere between 30 and 40%, depending on what state you're in. Yep. So goodbye to your investment. When you could be rolling an IRA to Roth and it only costs you 12%. Or 22%. So let's say it costs you 22% to roll your IRA to the Roth, but it's going to cost your kiddos 40. You saved 18% of your legacy that goes back to your kids. Yep. Like that is simple math. I hope you guys understand that. If you don't, you definitely need to come see me because you work so hard for your money. That's like saying, this is what it's like saying. You have $1 million, you pass away. Now let's say your kids pay 40% in taxes. They get $600. But if you do the tax planning now of your $1 million, what if they could get 800, right? I mean, that's just, you work so hard for your money. Don't stick your head in the sand and forget like this is a really important part.
Everybody wants to talk investments. I want to beat the market. I need 1% more. And then you do a tax bonehead play like that and lose 18%? Come on. You have to have an attack on your retirement and the money and a strategy for it so it handles all of this stuff. That is sitting down and really doing the numbers, crunching the numbers, or as Charisse says every week, let's do the math on your retirement. Do that at no cost or obligation. Give Charisse a call. Give the team a call. Here's the numbers. ZinniaWealth.com is the website. And when you go to the website, you're going to see a gold box. It says complimentary retirement consultation. Fancy phrase for, hey, let's have a meeting, a free meeting, a meeting that is no cost or obligation to talk about your concerns about retirement. If you uncover something like this, you're headed for a tax problem at age 73. Wouldn't you want to know that right now? Here's the number, 833-368-3680, 833-368-3680, or again, ZinniaWealth.com. So Charisse and I occasionally will talk about your 401k. Actually, we talk about your 401k a lot. Sometimes we talk about what's in there, and what's in there is something called a target date fund. You've seen them. They're in there. They have a year next to them. It'll say target date 2035 or something like that. And the idea of target date funds is as you get closer to your retirement, they get less and less risky. Seems pretty cool. Okay. Well, right now there are $4.8 trillion in target date funds, and that is up 20% from last year. So the article says the reason people love them is it's just such a simple concept. I get close to retirement, less risk. And people are pounding money into them left and right. But Charisse, you and I have talked about it often, that sometimes these things don't work. We've looked at the history of them. The risk factor means they go to bonds, and sometimes that is not the strategy. Talk to me about your thoughts on target date funds.
Well, I don't want to rain on the target date fund parade, but hey, everybody has a good day, right? So target date funds, we do smash on them quite a bit because they're cookie cutter. And the unfortunate part, when you have a 401k, you have a very small menu and you might only have target date funds. There's reasons why I like them, but there's more reasons why I don't like them. The reasons why I do like them is because as you get older, closer to that time horizon to retire, it automatically shifts you every year to something a little bit more conservative, and that is bonds, right? And then it still keeps you in equities. For example, a target date fund, depending on the company, 2030 would still have you very risky. So if you plan to retire in, 4 years, and you don't want 50 to 60% in equities, that's a big risk you're taking. So not all target date funds are created equally. And when we stress test your 401ks when you come in, we'll show it to you. We're just not going to say it out loud. We're going to show you the math and show you where the losses can come in. But that's one problem. But the second problem is, and we've seen it over and over again, it's going to be consistently bad. And I'll tell you the bond strategy. So if you're getting closer to retirement and it's pushing you to a heavier bond cycle and less equities, depending on that fund, and interest rates change, you're going to lose. And so you are getting closer to retirement. You have more bonds, yet they're pushing it. They're forcing it. You have no control over it. And now interest rates, let's say they go up, because we just went through that not too long ago. And so the target date funds weren't making 20%, yet the equities were going up. And people were like, well, why is my target date fund making 5% or 6%? And because they were just so heavy in bonds. So that's the only problem. So you have no control. So I call it a control problem for me, because a lot of you have mutual funds that you can choose instead of target date funds in those 401ks, which I prefer, but most people come to us and we give you the recommendation. But a lot of you who are 59 and a half and older, you could be moving those to a financial advisory firm locally, totally get out of those target date funds and actually get into something that's mathematically sound for what your strategy is about to be when you retire in 5 years or 10 years, or if you're about to retire, right? The beautiful thing about those 401ks is, I will say 9 out of 10 companies out there on average, as long as you're 59 and a half and older, you can keep contributing to your 401k and continue to get the match. But you're also allowed to do an in-service distribution and move 50% out, sometimes 100% out. So you can start working with an advisory firm locally. So you just have to ask your companies where you stand and can you do that? Because in my opinion, active management, a real human being you can talk to and do your reviews with and come up with those income strategies, growth strategies as you're prepping for retirement, is the way better strategy if you're allowed to do it. Now, if you're not allowed to do it, we'll still be happy to stress test your 401ks and at least give you the recommendation on, okay, here's your target date fund. This is what it's doing. Do you like it or not? Or should we use some of the mutual funds in your 401k if you get that opportunity? But what I don't like to see, what I see so often, Randy, is they'll have a target date fund and then they'll have the mutual fund. I'm like, okay, now we're overlapped. We're totally overlapped. And now we're taking more risks than we probably need to. So there needs to be some eyeballs on it. It needs to be some math. And if you call the company directly and work with the advisor that's with them, they're not going to give you anything but what they have. And half of those people don't even know what they're doing anyways. So we'd be happy to help you and stress test that 401k, especially if you're getting ready to retire. And if you are retired and you left it behind, get in here.
Yeah,
because
exactly.
There's so much more you can do with it, because those target date funds, Randy, they're still loaded in fees. They're funds of funds. That's all it is. Somebody's getting paid. You might not see it, but on average, we see 1%. I see 1.5%. If you're going to be charged for a set it and forget it strategy that is nonsensical during times of jiggly markets or jiggly interest rates, you might as well pay an advisor 1% to actually do something about it when those times come.
So while you were explaining all that, I did a quick Google check of target date funds and how they did in 2008. Okay, that was the big subprime mortgage crisis. So at that time, we went down more than 50% in the market. Was it 56%, something like that, Charisse?
50.1.
Okay.
Yes. And bonds went down an average of like 26, 28%.
Here it says.
That was just the S&P 500. Yeah.
So you don't want to lose 50%, right? Okay, fine. So the target date fund's supposed to protect you. The average loss in a target date fund in 2008 was 22 to 25%. I know that.
And that's with heavier bonds.
Yeah,
then.
exactly.
Okay.
Some lost as much as 37 to 39%. So
Yes,
here
and
you
even
are.
higher.
Here you are thinking, okay, I've got this hedge against the market. Market cuts in half. How did I do? You lost about half of that. Now, that's not as bad as 50%, but still, Charisse, you would think that you would do a lot better. There would be a lot more protection than that, losing 25 or even 39%. That's just not acceptable for your hedge against markets.
Well, here's the deal. The target date fund doesn't exit you when markets are crashing. They stay committed.
Right.
They're still making money on you when the market goes down. So if you lose 30 and 40%, they don't do anything. That's not their job.
Gosh.
When you come to Zinnia Wealth Management and the market's tumbling, we're moving you to cash.
There
That's our job.
All
right? So you can have a set it and forget it advisor, stock jock advisor, be charged 1% fee, and come to Zinnia and we do something about it. And you charge a 1% fee, for example. So you get to choose. Now get out there and interview advisors.
Come on in. Let's sit down and talk about, that's the one thing. Everybody's scared of a market crash. So you want to put something in there that's going to hedge against a market crash. Is a target date fund the answer? Maybe not. So, this kind of crosses over. Where's your money in your 401k?
Certainly not.
Yeah.
We'll say certainly not. If you have a choice. Some people don't have a choice, Randy.
Give Charisse a call. Let's do an analysis. We call it a portfolio x-ray. Dig in there and find out what's going on. And if you've got a lot of money in a target date fund, okay, well, let's see what the other options are. Here's the number. Here's the website for a no-cost, no-obligation look at your retirement. ZinniaWealth.com, ZINNIA Wealth.com. Hit the gold box. It says complimentary retirement consultation. That's a meeting, basically, to talk about your retirement. 833-368-3680 is the number. One of the things that people believe, this is a little bit of the Mythbusters segment of the program today. They believe that once they get into retirement, their expenses will go down and they'll spend less money. And that is a bit of a myth, and we're going to bust that today really simply because I know that I'm still working and my wife is on my health care and it costs about $600 to $650 a month, to have benefits at work. That's probably pretty similar to what you're dealing with. So you figure I'm going to go on Medicare. That's going to be so much cheaper. $205 a month per person. That's $410 a month. Then you get a supplemental plan at $100 each. Guess what? We're right back to $600. Okay. So that whole idea of you spending less money sometimes does not come true, especially when it comes to healthcare. Charisse, have you seen people that are surprised by that thinking, oh, I won't drive as much. I won't eat out as much. I won't do all that. And then they find, holy cow, I am. And I'm actually spending more.
Yes. So healthcare is always on the rise. It's the 800-pound gorilla in the building, in my opinion, because there's more people retiring each and every day. Medicare is a fabulous thing for retirees to get when they're 65 and older. And Part B premium is a real thing, right? It's almost like $203 a month. And for most people, Randy, I'll be honest with you, if they retired at 60 and they're waiting for their Medicare to turn on at 65, they typically are paying a lot more during this 5-year period, and they're walking on eggshells because they probably have a high deductible plan. Mm-hmm. So there is a higher percentage of people that when they do retire and go to Medicare, they do pay less, right? Because let's say Medicare for 2 people in the household is $406. Mm-hmm. And they don't get a supplement. Let's say they get an Advantage plan, so they don't have to pay a premium for that. So if they're only paying $406 a month, that is typically way lower than the $1,000 bill they were just paying because they were paying for regular insurance. Mm-hmm. Now, if you had an employer plan, most people are paying $200 a month, if that. So yes, you leave an employer plan. A lot of times you go to Medicare, you're like, okay, I'm on Medicare. Yay. Oh, I'm paying $400 and change a month for myself and my spouse. I'm paying more. And if you're smart, I personally think you should go get a Medicare supplement, which is another premium, because a Medicare Advantage plan, you have to follow a network of doctors. You can't go to the Mayo Clinic if you wanted to go. You can't go to that specialist that you want to go to, and unless you want to pay an arm and a leg or pay cash. So then you pay another premium to get that Medigap, that gap to Medicare, what Medicare doesn't pay. And that's all day long, another $150 to $200 a month. So let's say it's $200. So now you have the couple who pays, I'll just do simple math, $400 for Part B. Then they pay $400 for the supplement. Now we're at $800 a month. And then you got to go get a prescription drug plan. Let's go ahead and just add $50 a month for that. I mean, we're $900 a month all day long.
Here we go.
But for those people who were just paying $1,800 or were on COBRA, they're like, oh, this is the cat's meow, right? And so everybody's a little bit different. But I will say, a higher percentage do pay less unless they're coming straight out of an employer plan. So those costs are on the rise.
Yep.
And it's eventually, the costs are going to go to you guys. So let's make sure you get the right plan, the right coverage. Sometimes a premium is worth paying to get freedom of choice. Okay. There is an Advantage plan called Freedom. I'm not talking about that freedom. and so just making those right decisions, and it goes with anything. Costs are always changing. I mean, look at gas prices.
I know.
Right?
Yep.
Taxes are good to us right now, but those could change one day. Food, inflation. So there's a lot of costs. So how do we control our costs? So we really have to dial into the expense report when people are coming in, and their travel report, like how much are we going to spend? All of a sudden, remember after COVID, it was so expensive to travel. And then it's coming down a little bit, but it's still expensive. So the inflation on just travel today. So there's a lot of costs, more than just healthcare out there. We just want to make sure we're keeping up with inflation, making sure we dial into the right healthcare plan when you're aging into Medicare, or if you're prepping before Medicare, and try to get it right the first time, right? And most people don't always get it right the first time when you are a DIYer, unfortunately.
It is interesting. You hear these words like the PPI and the CPI, the Consumer Price Index, and all that. I think they should have the RPI, the Retired Percentage Index, because, I mean, think about it. Think about the things right now that we're dealing with that are almost specifically focused right on retirees. Going out to eat has gone crazy, and that's what people in retirement do. Travel has gone crazy. All this stuff that retirees do, they're getting hit pretty hard right now with that inflation. So let's sit down and have that built into your retirement plan. The whole idea of healthcare and trying to balance Medicare, Advantage plan, supplemental plan, drug plans. What do I do? What are my doctors? What are my ailments? Okay, there's a lot to talk about there. Let's get that all out on the table. Give Charisse a call. Let's talk through it. 833-368-3680, 833-368-3680, or use the website, which is ZinniaWealth.com, ZINNIA Wealth.com. Father's Day weekend here, so I got a Father's Day story for you. This is in Mobile, Alabama. There's a restaurant there called Winsel's Oyster House, and they have a sign up there that says, once you turn 80, if you bring in your dad, you eat free. That means dad's got to be pretty old. And it actually just happened. Jimmy Rush and his dad, Jim, he's 99 years old. They've been waiting for this, and they finally got to cash in.
Every year we ask them about the sign, and they tell us every year we're waiting on us to come in. So it finally happened. We had oysters. We had for everybody there, and we really had a good time. We finally did it. We had a great party. I don't think I could have had a better 80th birthday.
There you go. I love it.
That's so sweet. They sound so cute.
There you go. There you go. All right. So what I want to talk about is this. Jimmy and Jim obviously have a family where they have a lot of longevity. He's 80 and dad's still around at age 99. And so that's one of those things that, you never know. But if it's in your family and you have relatives that live into their 90s, Charisse, you got to sit down and say, hey, here's something that you're going to have to deal with other people don't, and that's longevity. We got to figure that you're not going to be in retirement for 20 years. You may be in retirement for 30 years. So let's talk about that. that kind of adds a whole new wrinkle to the plan. So talk to me a little bit about, do we have to have more risk in our money to make it last longer? Or how do we go about that?
Well, and some people can live 40 years in retirement, Andy. I have a client like that.
Really?
And
wow.
I do. It's so cool to watch, though, over the last 20 years, to literally watch my 7-year-old client like turn 90. It's a neat thing for me to see, and to watch all of my clients age and go into a new season of life. To be honest with you, I was just talking about that with my client who was with us, who has been with us for 10 years, and they were 65. And I said, can we believe we're 75? They're like, Charisse, you're not 75. It's not a we. I'm like, it's a technical we, because I'm growing with you and I'm learning so much. And you know what? My clients they look the same to me. It's amazing to me, from 65 to 75. It's actually quite the anomaly to see that and to see the age stay very, very similar and everything. Nevertheless, that's not what we're talking about, but we have to plan for longevity, because longevity continues to be on the rise. And with artificial intelligence and new surgeries and these prescriptions, believe it or not, you all, we are going to live longer than you probably expect. And my mom is a prime example. She said, honey, I'm not going to live past 75. I'm like, you're insane. She's about to turn 80. I was just telling her the other day, I'm like, look, you made it to 80. I'm like, now you're going to go to 85. She's like, oh no, I'm not. I'm like, you have a force hand. I think there's some good genetics there. And I'm like, for my son's sake, they're so bonded, but we have to plan for income. So let's say you retire and you're 62. And you have a Social Security check, you don't have a pension check, but you saved $1 million. I always use that example. It's easy. And your Social Security check between you and your spouse is $40,000, and you need another $40,000. So that $1 million, if you happen to live 40 more years, has to stretch out that long of a period. And for heaven's sake, we don't have a big emergency or a long-term care problem down the road. So how do we take $1 million and say, I need another $40,000 every year for the rest of my life, and keep up with inflation and the new roof and another car and then some dentures or implants and all the other things, and then the grandkids, right? Maybe you want to start at 529. And so all these things that we don't think about as we're prepping for retirement, how do we make that money last? Because if you need 40, but now we need another 20 every year for one of those things that arise, how do we make sure that money is still coming in every year for another 40 years? So this is why we created this income plan. This income plan is the most important piece of all things that we do here at Zinnia Wealth, because my goal is to make sure my clients do not run out of money. My second goal is to make sure that you front load your retirement the first 10 years so that you can enjoy your retirement. And then we show you, hey, after 10 years, we spend all this money on travel. Most people want to stop spending that much money on travel because they're just tired of traveling. Because when we do it right, we do it right here at Zinnia. And we're gonna push that envelope for you because we know what will happen when you turn 75. You will slow down. There'll be a health issue. There is something that's going to happen. It typically, like clockwork, happens. Now, we want to make sure in that pot of money, that $1 million you save, that not only are you doing those things that you need to do for your home and your health and for your income, but then what if somebody goes into a long-term care situation and now we have to bring somebody to the house and we need to pay an extra $25,000 a year to take care of maybe your spouse that you can't take care of because they're 2 foot taller than you. Maybe this is a bigger human being, right? That is typically because usually it happens to the male and then the woman is taking care of them, but you can only do so much before you break your own back and you're in the same situation. So we got to make sure those dollars are sitting there and available. So how do we unmask this creative income plan? Well, we do it through our software. We don't guess. We don't hope. We dial into the math and we just show you, what if somebody dies early? Okay, we lost the smaller of the 2 Social Security checks. Do we have enough saved? Okay, we do. Good. If not, do we need a special investment to replace that Social Security check when that person dies? I mean, it's that simple, you all, but we have to at least test it. What if somebody dies? What if you both are living and one of you at age 80 years old goes in a nursing home for 3 years and you're paying $600,000? How does that derail the investment and the income for the spouse still living in the house if we don't have a long-term care plan. And so on and on and on. The costs to do home health care and then widen doors, put the rails up, if you're paying your own money for these things, all those things add up. So we want to say, what if? And we want to test it. And everything looks good. And we can front load your income in the beginning years. Man, I just truly believe that our clients are less stressed because they can see this. And then the years that they need money, we go back and we stress test their income plan. Okay, you need $50,000. You're going to go buy this property in New Mexico. Oh, okay, let's see how that hurts or helps your portfolio. And at least they know before they go do those things. So the income plan is very critical. It is the foundation of all things you do. And I know we talk about investment plans are really important and tax plans and estate plans, but that income plan, if we don't dial in, if you don't have an income plan, I feel bad because how do you know, right? Yeah. Like and my early years in this business, we've been doing this for 20 years, Randy. The first 10 years, I didn't have an income plan. I was just selling products. I didn't know we needed an income plan until I realized, okay, how do I know they're not going to run out of money? Like, have I done the math? No. And so again, it's really important that we do this. We love it. It is critical. And if you don't have one, come in. We do them for free.
Charisse, earlier in the show today, we talked about one of the things, or as many things as we could come up with, that DIYers kind of don't think about. And I think that this is one of them. People say, oh, I won't live to 80. Oh, I won't live to 85. People underestimate how long they're going to live. And I talked to somebody the other day whose dad said, well, this is my last car I'll ever buy. And then later on, he looked at me, he goes, he's on his third last car.
Yeah, so, exactly.
Yeah, I mean, that is one of those things that is up in the air and we don't know. We have to look at our family to say, how long did they live? Is there longevity in the family? And then say, okay, let's make the plan. So maybe my plan doesn't go to 90. Maybe my plan goes to 100 because that's what's going on in your family. That is the discussion when you sit down with Charisse. It's digging into that kind of stuff because those variables we've got to have in the plan. Give Charisse a call. Let's sit down. No cost, no obligation. Look at your retirement. Let's talk through all of those questions. 833-368-3680. 833-368-3680. Or the website is ZinniaWealth.com. ZINNIA Wealth.com. There's a gold box there. You click on that. It says complimentary retirement consultation. That means it's a meeting. It's a meeting about your retirement at no cost. Sit down and talk about your concerns and how we may be able to help. Again, ZinniaWealth.com or 833-368-3680. Charisse, that is all the time we have on this one. I'll give you the last word.
If you want to spend more in retirement, pay less potentially in taxes, and be more diversified, you're going to want to hear this show. So as usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.